Well, good morning, everyone. Welcome to our Friday morning session. TGIF and all that. Okay, let's see what's going on this morning. This is the NASDAQ on this particular monitor. For those of you who are new to the room this morning, welcome. And what you're looking at is the diversified trading system. And the way I have mine set up is I have the Hawk Scalper here in the top left, Falcon Swing Trader top right, Eagle Trend Trader bottom left, and the Raptor on the bottom right. On this monitor I've got the NASDAQ. On my other monitor I'm watching soybeans and crude oil, but I would be happy to take a look at any market you are interested in. Let's take a look at where the NASDAQ has been, where it's going. You can see we're very much in an uptrend for at least a few days now. Looks like we've got a couple different trends going on here. It looks as though we're right back down here to this trend line support now. We have had a test of the extreme. We'll see whether or not the NASDAQ actually continues lower now. Fairly substantial sell-off out of the open. Soybeans also, we had a tradable signal here if you were watching soybeans earlier. Just slightly pre-market, we had a trend change signal. Very good progression out of that. Fantastic move lower. Crude oil, well, here's crude oil on the Falcon. Right out of the open, also a trend change signal for crude oil. Came back, gave us a late filter entry about 15 minutes later. Now it looks as though we're doing a little bit of a retracement. Crude oil very whippy the last couple of days. Big moves higher and lower. Just like crude oil of the good old days. Don't really know what to expect. Just letting the dust settle a little bit here. We just saw a Raptor signal as well. We had a trend change signal here on the Raptor. But honestly, I'm a little bit reluctant to sell at the moment. While the trend doesn't look quite as strong here on the Raptor as it did on the Eagle, we are in a bit of an uptrend in the NQ. So here we're actually getting one of these variations on the hard edge bounce with the Eagle. Now I know the band technically has flipped over. It's technically bearish, but just barely. We are getting a red bar buy. We know when we encounter the hard edge, we should see some sort of reaction. You see, it happened down here, although it didn't get low enough to actually twist the band out of shape. This is a little bit of a higher risk scenario, trade-wise. Okay, and we'll scrub that order now. A little bit of a push lower. We'll see how the buyers react. You see, we're back down here now to this 42, 46 area where they found support before. Let's see if they rally it. If they do, the pressure is going to be on the sellers to recover this market. And if the sellers don't, well then we should have a buying opportunity. Notice our hawk, early on already, it's producing a lot of yellow bars. Our first micro-macro crosses have worked out, so we've been very fortunate there. Here's a green bar sell, and here's a green bar sell. So if you wanted to get an earlier entry, you could look at buying that green bar sell. Normally we only see 2 green bar sells within a trend. Normally. You know, there's some markets like the mid-cap, they tend to produce a few more or more reliable red bar buys and green bar sells. And it's still early too, isn't it? It's only been a few minutes after the market opened. Okay, well, we can cancel that. Let's put that away. Let's take a look here at, oh, we had a late filter entry here on soybeans that just tripped. But you know what? It might still be to our advantage to take it below the lows, cover it above the highs. It's not ideal because, of course, I would have liked to get the earlier entry here, but it does look as though this still has the potential for a pretty good trade. All right, yet another first micro-macro cross signal. I tell you, all this choppiness though, all these yellow bars, it is giving me pause. I'm not really keen to short it. So what I'm looking at is the failure here of the green bar sell. And of course, if we get the other failure of the green bar sell, we might actually see a little bit of a push to the upside here. So we've had several moves lower that may count as a test of the extreme. We've just broken this high, waiting for that other push to the downside. Now we're also generating a first micro-macro cross to the upside. I'm glad the market is finally seeing things my way. Okay, there we go. We hit our first profit target. Let's see where our stops are trailing. I'll hold my stop just a little bit longer. And I heard a swing signal. So are we getting a trend change signal yet? Nope, not quite yet. That was a trend change signal in crude oil, but here we're right up against the hard edge on the Eagle band. So once again, we're more in a downtrend right now than we are in an uptrend. You always need to be a little bit leery when you're trading into a dominant trend. Now, does that mean you shouldn't take the signal? No, not at all. But maybe we'll look at doing a second push entry. Maybe we'll dial down the risk amount so that if the trade doesn't work out, we don't get clobbered. And if it's too much for you, then maybe it's just a trade that we have to ignore at this point in time. There will be trade setups that you cannot afford. Well, here come the sellers again. Doggone it. Get up there. Nope. Wow. I did not think they would recover that again, but obviously they did. Okay, we're looking at another first micro-macro cross signal here in the hawk, and we know it's a high probability signal. My concern is that we're going to get a macro pullback. So if I'm going to take this, I'm going to have to cover it. I'm either going to have to enter late or I'm going to have to cover it deep. Or I can wait for a second push on the entry. So we've engaged the signal here. And you can see how the bar is struggling. They're trying to get a little bit higher, so that tells me the current limit that the market is at. Come on, make that pivot. Come on, get up there. Show me that there's really some buyers down here. Nope, no buyers. I don't know. It's Friday, right? I should have taken it there. Oh, they turned just shy of the profit objective. Oh well. Won't be the last trade I miss, and I'm sure it won't be the last opportunity today either. Okay, while we're waiting here, Alan's posted a very good question. Alan asks, hey Eric, when you have a minute, would you talk about why you might use market orders for entries versus limit orders? I'm using the trade manager and was wondering if it always puts a limit order in for the exit. If so, is there any chance of your order not being filled? All right, well, on the entry side of the equation, the difference between a market order and a limit order is a market order always goes below current price. A limit order always goes above the current price. If we're selling, sorry, I should clarify that. If we're selling, the limit order or the market order always goes below, the limit order always goes above. So you would use a limit order, let's say we drew a trend line like this, and you're expecting the market to find, oh, here, actually, let's use our macro pullback line. Let's say we're expecting this to develop into a macro pullback. And so you start looking at this and you say, well, wait a minute, there's some resistance right here, right, all those lows. What if the market trades back up here? I'd probably want to sell it. Well, you can't place a stop order up here. Oh, it didn't. You can't place a stop order. You're going to get a warning saying stop orders cannot be placed above the market. So in that case, you need to change and use a limit order. And what that's going to do is it's going to set the limit that you will accept as a fill. In other words, you are limiting your entry to 42.45 and a quarter. That is the most that you will pay for it. Now, remember, you're selling, right? So if you sell 42.46, that's actually a better price for you as a seller. You're getting a better fill. And I should do this from the buy side. It usually makes more sense to most people. But just remember that a limit order always goes above the market if you are selling. Oh, I'm going to confuse the heck out of you, I know it. A market order, we use market orders because I like to use market orders because they pick up on existing momentum. A limit order, you're anticipating the market to give you momentum, right? You're anticipating that this support area is going to hold. Limit orders are great because if you plan them right, you can get some very excellent fills. So let's say you were looking at, and there are people who do this all the time, you know, people who follow trend lines. They're going to start throwing in their limit orders here and hope that they get filled when the market hits the trend line and that the market will reverse and go their direction. Now you're going to notice, depending exactly where the price was, these guys here probably got filled. These guys never got filled. These guys got filled, but the market may have drifted deep enough that they actually got filled and stopped out at the same time. Oh, did I not submit my order? Okay, so you're going to see we're going to get filled here in a second. Now, a limit order, unlike a market order or a stop order, the limit order actually has to trade through this price. We are looking for 42.45 and a quarter or better. If it touches 42.45 and a quarter, we will not get filled. So we needed to actually go 42.45 half. And you can see in this instance it actually would have worked out pretty well. Okay, now notice we got filled because the market traded through. And now we're hoping that this trend line is going to hold, that we're going to see a macro pullback signal or 4-arrow consolidation. In other words, you use limit orders to anticipate what the market will do. Now, if we're using a stop order, and we'll give this a second here, I can do a stop order on another chart. If we're using a stop order, well, where's there a signal? Okay, here's a trend change signal. If we use a stop order or a market order, now a stop order, I'll do that first. If we're going to sell, the stop order goes below current price. So currently the market is trading 42.41. I want to sell 42.40.75. So I'm going to sell one tick below where the market is currently trading. And what happens is when the market trades lower, my stop order goes to the floor and automatically becomes a market order. So whatever price the market is trading at, that's the price I'm going to get. That's why sometimes with a stop order or a market order, you might experience a little bit of slippage. You don't get slipped on a limit order because you've limited the price that you're willing to accept. If you do experience slippage on a limit order, it is always positive slippage. It is always slippage in your favor. But because you are limiting the price that you will accept for a fill, it is entirely possible that the market will trade on without you. So sometimes what guys try to do in order to avoid slippage is they'll watch a signal like this and they'll actually park a limit order here. They'll set up their trade, but they'll set it up with a limit order instead of a stop order. Then when they see the signal trigger, they'll hit the submit button and hope that the market will trade around this price at least for a few seconds to get them their fill exactly at the price that they want. Now there is a combination, there is a variation of that. It's called the stop limit order. And with the stop limit order, you can preset how much slippage you're willing to take. You can even set it to 0 if you want. Oh, no, I guess you can't. Yeah, that would make sense, wouldn't it, Eric? You can limit your slippage to 1 tick. So what you do is you set your order just like you normally do. And now it's a stop order. So once that price is engaged, your order automatically goes to the floor. However, you've limited the amount of slippage that you're willing to accept on that trade. I'm hoping this makes sense because I know it can get a little bit confusing and I'm kind of butchering your question a little bit. Now the other side of your question was, what about the exit order? Your exit order will always be a limit order. In this case, it's going to be a buy limit order because we have sold. We need to buy to offset our position. One thing that people are unclear of in the futures market is that unlike the stock market where you actually buy and sell stock that you own, futures are a contractual market. So you are contracting to sell the NASDAQ or the soybeans or crude oil at such and such a price and then you are contracting to buy it back at such and such a price, and hopefully you get to keep the difference. Think of it as, again, from the buy side, it's a little easier. If we think of it from the retail environment, if you're Walmart or whatever, Joe Blow hardware store, and you buy something at $5, you hope to sell it at $10 and make the $5 difference, right? Same idea here. You're committing to sell at this price, and you're hoping you can buy it back a little bit cheaper, and then you pocket the difference. So your buy order or your order to liquidate or flatten your position is always a limit order, and yes, there is a chance that you will not get filled. The market can come down here, tag 42.35.75 right on the nose, and you may not get filled on your order. Ideally, it would trade 42.35.50, and then you're guaranteed to get a fill, because your order would have to get filled before it could hit 42.35.50. And I'm sorry if I've confused you even more. It's really not that difficult. Just remember your buy stop or sell stop, always above, always below, depending whether you're buying or selling, and then your limit will be the opposite. Oh, Alan's asking on the stop loss, is it guaranteed to fill? Yes, because if your stop loss is hit, the market has just traded through your price, right? So here, if we set up here, if the market trades lower, it's guaranteed to hit this. Your stop loss is actually a stop, a sell stop. So we've had a buy stop here to buy, and we have a sell stop here to sell. And the stop orders, when that price gets hit, they automatically become a market order. They have to get filled at whatever the current market price is. There's no ifs, ands, or buts about that. They will get filled at whatever the current market price is. Alan says, what's the difference between using a stop and a market order? Okay, well, let's play here. Let's throw a stop in. Oops, sorry, wrong order. This is one thing you have to pay attention to, is if you're switching your order style a lot, pay attention to what order you have in play. So here we've got a first micro macro cross. We're back on the highs. If I set a stop order, okay, did that order engage yet? No. Why not? Well, because the market hasn't hit my price yet. Should hit my price here in a second, I hope. Come on, get up there. Okay, well, they're not going up. So this order will sit here. It'll sit here all day until the market trades 42.49.50. And if it never trades 42.49.50, this order will never get filled, right? Okay, so let's cancel that. Now watch what happens when I hit the buy market button. I got filled, didn't I? I got filled immediately at whatever price the market was trading. If I hit buy market again, now I've got a quantity of 2. And I immediately get a fill at whatever price the market is trading at. So that's the difference between your your stop order and your market order. Your market order is immediate. So you could, if you're watching, rather than park an order here, you could watch the market trip your signal, and if you like what's going on, you could just punch in with a market order. I have done that. I don't do it that often here in the room, but occasionally there will be circumstances where the market is perhaps moving a little bit too fast. It's rare, but it happens. So rather than, grab my tool, set my trade parameters, hit my submit button, I can just punch in a couple of clicks on the buy market or sell market. And remember, you could always set your quantity up here as well. All right, so this is a first micro-macro cross to the upside. James is asking about the YM. Sure, let's take a look at what's going on in the YM. Don't tell me they're screaming higher this morning again. And I'm about to show you something that you should never do when you're in a trade. And that's change your chart. My trade, see my NASDAQ trade that's going along here, it will still be on the exchange level, but when we come back to this, providing we don't get stopped out in the meantime, it will no longer be on my chart. So when you have a trade in play on your chart, don't touch it. Like your mother told you when you were picking at that scab, leave it alone. All right, let's see what's going on here with the YM. Let's start with the Falcon. Ooh, a real roller coaster. Wow. Yeah, some pretty wild swings going on here in the mini Dow. We are trying to put in a buy here. We do have a little bit of a trend change signal going on. The market did go out of sync here for just a couple of bars. Our filter flipped over too. Sometimes, if it's only out of sync for a bar or two, I will ignore it. Now, technically, it's not a pure signal. However, chances are that this market, this bar right here dipped just low enough by a tick or two to change the trend line. Otherwise, it would be a late filter entry. Of course, you can always look to trade above the recent swing point, which sometimes makes it a little bit better, a little bit more palatable. Let's take a look here on the Eagle. Well, you see our trade forecasters, we're full on scalp mode for the better part of the next 40 minutes, according to Trade Forecaster, and that's exactly what it looks like here. We almost seems as though we're seeing a breakdown, though, and this was true on the NQ also. I was being a little bit too stubborn to admit it, though. We have had a test of the extreme. We've got at least 3 breaks against the hard edge, so we do have a rule of 3 signal here, and we might be seeing the YM fold over, maybe. Kind of a congestion, a wedging. We'll see if they roll over again here. If they do, we could expect another swing and maybe a break higher. That tends to be how these wedges play out. Not always, of course. Nothing is always in the trading world. Yeah, so they're pretty content to be going sideways right now. Here is the hawk. You can see a lot of yellow bars. First micro macro cross higher. Let's see, have we found our profit objective yet? We must be close. Oh, look at that. Just turned shy of our profit target. Yeah, that would be a bit of a nail biter. Whenever you see all these yellow bars through here, though, all this obvious chop, all this breaking up of your filter, it's probably a good idea either to identify the range that you're in and let the market get outside of this range, or start dialing down your risk exposure. Okay, let's go back to the NQ and see what's left of my trade. Okay, I don't know if my stops got hit. I should have sent my stop deeper. Maybe my stop got hit. Because what I was going to show you is, oh, sorry, still waiting for the Raptor to load. What I was going to show you is that my order would still be active here. It would still say, it would still be a highlighted order. Or if I went to the DOM, which is this funky tool right here, and I plugged in my accounts and my instrument, all right, where are you? That's odd. Well, it would have shown, or it should be showing, my my order there if it was still active. But the point is, if you have an order in play, don't touch that chart. Okay, so we're getting a trend change signal here on the Falcon now, here in the NQ, and we're getting we did have a 4-arrow consolidation here in the Hawk This is a signal that I will take on the yellow bar. It is the only signal I will take on a yellow bar. It's a 4-arrow consolidation. James is multitasking. He says, thanks, Eric. I was coaching the wife from work on the YM trade setup. Oh, when you change your charts as well, this is interesting to note, you're going to see that you go back to your default settings. And what I wanted is I wanted to have a runner in play here. So I'm going to cancel that, and instead I'm going to sell a limit of 1, and that should enable me to have a runner on the rest of my trade. Now we're encountering all this resistance up here again. This was this nastiness that we hit before. Let me clean this up. So we know there's some buyers around here, or pardon me, some sellers around here. So expect them to knock us down a little bit. Well, they didn't put up too much of a fight there, did they? Let's see here on the Falcon. I could do the same thing. I could put a runner in. So if you forget to split up your orders initially, you can always scale out of a position this way also. So I could set, say, another profit target up here because I'm long 3 contracts. Soybeans acting a little funky this morning. We've got a first micro-macro cross now to the upside after this rather large move lower, or initial move lower, I should say. So it looks like they might be trying to press the market a little bit higher, and we're getting a late filter entry signal building on the Falcon also. So a little bit of floundering here. They've broken the high, and we know that whenever the market breaks a major swing point, we can usually expect 2 moves in the direction of the breakout, right? So something to look for here. Potential late filter entry signal. Hasn't built into a late filter entry yet, but it's getting there. And the NQ's a real mess this morning, my goodness. Come on, boys and girls. Why can't the market just make a straight line where it's supposed to go? Wouldn't that be nice? Okay, we're seeing a little bit more buying pressure here on this tug of war right off of this resistance here. See how this bar is flip-flopping? It's probably one that at this stage, given this bar, given the time that it's taken here, you could probably bring this trade to break even. Might not be a bad strategy. Here we go. Come on, don't stall now. So now that we're through here, the sellers are beating up on us a little bit more as we're getting closer to the primary resistance area. And you can see there was active selling going on here in the past. So it's to be expected that they're going to try to force it down from here. We've got, relatively speaking, we've got a pretty tight stop. You know, there's traders who are running a stop like this. The big money traders, they'll probably have their stop below here. I can't afford that much. Well, I can afford that much risk, but it would mean trading a single contract, which is fine. There's nothing wrong with that. Remember, trading is as much about probabilities as anything else. But the way I have the trade set up, I'm pretty much looking at a tighter scenario and immediate momentum. Okay, so I may as well, excuse me, I may as well get this trade to break even also. So now we're playing with their money, so to speak. They're trying. They're holding on. Get up there. Ooh, all right. Tom says the YM has just tested and broke the 30-minute high. Let's bring the mini Dow back over here. This is on the Falcon, of course. We're seeing a similar picture. Let's see if this doesn't come back and give us a trend line touch and come out of that with a buy signal. I could be persuaded to buy that. The hawk is already showing us a couple of signals, a little bit of congestion here. We did have a first micro-macro cross right down here. This may develop into a macro pullback or 4-arrow consolidation, but if you wanted to park an order to take advantage of the market if it bolts on you, that's probably as good a setup as any. So we'll keep an eye on that one too. This is a little bit of a concern as this was changing to a red bar. Sometimes when you get one red bar like this, followed by a green bar, followed by another red bar, that tells you you're going to get more red bars, in which case you may just want to close out the trade and take whatever open profit you have. Hopefully this bar will finish green, and that'll buy us a little bit of breathing room. Come on, get up there. Almost back to where we started the day. I think we started the day at 42.60, didn't we? Or thereabouts. Come on, get up there, you stinkers. Come on. You know you want to. Wow, what a line. This whole 42.55 area. What a battle. Uh-oh. All right, so this, like I said, normally develops into a series of red bars. So let's see, what's the open profit? 140 bucks. So if that is dear to you, then hit the close button. If you're going to let it ride, well then at least have your trade to break even. I don't think we're going to see a full-out reversal here. I think we still have a little bit of a bullish bias today. But there's no denying that we've got some selling pressure at the moment as well, due to all this old resistance. If we can fight our way through that, we should be in the clear. Okay, here's our YM hawk trade. It's since developed into a macro pullback signal, so that gives us the opportunity to adjust the trade parameters somewhat. And all I'm doing here is I'm trying to run a deeper stop, right? If the market comes up here, we haven't really touched the macro line yet. So my thinking is if the signal prints, it goes higher and then tries to reverse to the macro line. If I run my stop too tight, of course, I'm going to be in trouble. So here we have a chance to adjust it again, and it gives me again an opportunity to perhaps run it a little bit deeper. And then if the trade starts to go my way, well then I can adjust the stops accordingly. But it looks like we're going to be challenging our break-even stop here. So here's that series of bars that I was telling you about. And with a little bit of luck, the buyers will recover it before we hit our break-even stop. Notice where the ATR stop is actually down here. That would still leave me in a risk position, and I don't think I want to do that right now. The YM on the Falcon, working on a possible late filter entry signal. So we've come back here into the trend line, and we might be coming out of it with a buy signal. They are reluctant today. Early selling, good momentum on the sell side. Oh, speaking of first micro-macro cross signals, we have a similar setup here in the NQ. And same thing, I would try to cover it a little deeper. We should see a test of the extreme before a failure. Oh, it did it again, didn't it? I forgot to adjust this. So I'll sell 2 there. and see if we can't have a third on as a runner. And stop it. Okay, so here's our NASDAQ and our YM, both off our macro pullback signal. And I haven't adjusted the stops just yet, but we'll see if there's a little bit of a trend line going on like that. See if we can't get through that first. The YM actually being a little bit more cooperative, just hovering below our first profit target. Don't turn now, YM. Get up there. Yeah, this whole 42.55 area, a real battleground. Okay, the YM on the Falcon is printing or about to print a late filter entry signal. It hasn't printed just yet. We do have the warning dot. We can set everything up, park our order, and engage the order when this actually trips. It should print the hash mark, triangle hash mark, if this bar finishes green. But we'll keep a lookout for that. It's the YM again. Get up there. See, this is one of those situations too where you could hover on the buy order, set your quantity for whatever your risk amount should be, and sit on the buy order. In fact, why don't we do it that way? I'll sit on the buy order and I'll wait for that triangle and hash mark to print, because I intended to enter right on the hash mark. Maybe we'll try to scale into this one as well. I can't say I've ever used the buy, sell, bid, ask buttons. It's more of a Forex thing, I think, where the spread between the bid and the ask is huge. Or it can be huge. Criminal. All right, well, we'll come back to that. Tom's got a question here about the eagle. He says, what's the difference between the ATR line and the ATR stop on your eagle tool? Well, actually, not too much, Tom. In fact, we borrowed the ATR line from the ATR stop strategy, believe it or not. So if you go down here to your indicator panel and you roll to all your IW ones, you're going to see you have all your different stop strategies available. You have your IW Trade Manager percent trail, fixed trail, chandelier, ATR, which is the one that I have, super trend. So it's set at a length of 14 with a multiplier of 2. So you'll see here if I change my stop strategy to that, it's going to follow it exactly. So why would I use the ATR as a filter? Well, it's, like I said, it's something that Mike Filigera put me onto. The ATR, of course, stands for average true range. So what you're looking for is just for things to be in sync, for the average true range of the market to be in line with the rest of your trade. And like anything that you put on your chart or choose to put on your chart or not put on your chart, if you find it helpful, then by all means use it. But if you find it distracting, get rid of it because you really don't need it. However, this is one tool that I found for the sake of a couple of ticks. A lot of times it gives me greater confidence to be buying or selling in sync with the ATR line. And I know Mike Filigera is actually a little bit even more aggressive on it than I am. So what he will do is a signal like this, he will actually buy because it's in sync with his ATR line. A signal like this, he will sell. Even though it's contrary to the band, he will sell this red sell signal because it is in sync with the ATR line. And you can see, I know Mike follows the NQ. Right now, he'd be a pretty happy camper that he actually bought that signal. So it's not something that I've mentioned in the room, but it is a viable strategy. So when you're printing buy signals and your ATR line is in sync, that gives you a little bit more confidence to take that buy signal. A lot of times if the ATR is against my signal, I will wait for a break of the ATR so that everything comes into sync. We've never upgraded the tools. It might be something to look at in the future. Just building the, what I mean is building the ATR into the Eagle system. Yeah, ATR at 2. That was Ray's favorite setting. Ray Burke, or I shouldn't say was, Ray hasn't died, is Ray's favorite setting. But Ray, hey, you guys know Ray. He's a type A personality, right? It's like, let's go, let's get her done right now. Ray is not exactly the most patient trader, but that's okay. That's how he is. You know, we all have to uh, know what kind of people we are. That's what I say to folks when they start trading. You will learn more about yourself as a trader than perhaps anything else that you could ever do. You're going to learn whether you are patient or impatient, or whether you are, um, anxious or fearful. And I'm not saying these things in a negative connotation. It's just the way you are, right? If you have, and like here in this trade, we have $160 in open profit. Well, $160 is $160. That's nothing to sneeze at, right? It's a tank of gas for your Humvee. It's money in the bank. It's yours right now. If that $160, $170 is dear to you, then take it. No questions asked. There are, like I said, there's no judgment call. It's entirely the type of person you are. That's why some people are better suited for scalping. You know, when I started day trading, I was a $50 scalper. Get me in, get me out. I don't care if the market goes along without me. Just give me my money now, please and thank you, and that will be that. But then, as you get more comfortable with your trading and perhaps you come to terms with some of your negative tendencies, and I'm saying negative with air quotes, where perhaps you get a little bit too anxious on a trade. And this is why journaling your trades is so important. Maybe you'll start experimenting with having a runner in play, where if the market does move higher on you, at least you've had a chance to take part in that extra move. So like I said, that it's neither good nor bad. It's just the way you are, and we're all different. Some people can tolerate more risk. Other people can't. I better make sure this fellow's not in the room this morning, because he's going to think I'm picking on him. No, okay, coast is clear. I was coaching him, and he was all set to do his first live trade, and he says, well, Eric, should I take this trade? And I said to him, well, I can't tell you how to spend your money. It's your money. But I said all the parameters are there for a trade. And he was trading a $60,000 account, so he was well capitalized. And it was only a $200 risk position. So minimal risk. And he gets into the trade, and the bar ticks up, and he says, oh, good, trade's going in our favor. And it ticks down, and I was quite surprised at his reaction. Like, it had only ticked down a tick or two, and he's cursing himself under his breath, and I can hear this, right, because he's wearing a headset. I can hear the microphone. He forgot to mute. And, he's cursing himself, you stupid idiot, what were you thinking? And it goes up a little bit, and he says, oh, okay, everything's all right. It goes down a little bit, and he's belittling himself again and stuff. And the trade eventually turned against him and stopped him out for $200. And you thought he had just lost $20,000. And I said to him, are you sure you want to be a trader? Because losing trades are part of the business. And it's only $200. You're trading a $60,000 account. This didn't even scratch your account. And if you can't get that emotional in a trade. That's why we use the trade manager. Do I like posting a negative number? No, of course not. Nobody does. But you can take a little bit of solace in that you haven't risked more than you can afford. And you should always have a pain threshold for every day. You know, if your pain threshold is $500, then fine. If you lose $500, you stop trading. If your pain threshold is 1,000 or 1,500 or whatever it is, mine is 5%. If I have a 5% drawdown on the day, that's it. I'm packing up my toys. I'm going somewhere else. Probably the golf course. Because I know if I have a 5% drawdown, it's not insurmountable. I can probably get it back in a day, maybe two. But if I have a 15% drawdown or a 20% drawdown, that's a bit of a deeper hole to dig yourself out of. But the whole point is, know thyself, trader. And that's trader, not trader. And, you know, go with it. Like I said, it's neither good nor bad, but you have to know what kind of person you are. If you can handle the heat, then great. Handle the heat. If you can't stand the heat, that's fine too. Don't stand the heat. Don't torture yourself. See, like, look at me. I'm starting to feel the heat a little bit, so I'm switching over to parabolics, which I know are a little bit more aggressive. We've had a nice run up here. What's our open position? $240. It's not chump change. Not by anybody's stretch. I don't care who you are. $300, nearly $300 open profit in this one. That's substantial. Tom says, I'm a yellow belly. A yellow bar equals belly bar. Like I said, folks, there's no right or wrong. If you're an anxious trader, just recognize the fact that you're an anxious trader and you're going to be more comfortable taking your profit when you have it. If you're the kind of trader who hates to miss out on a big move, you know, if you can't stand missing this signal, which, by the way, was a very good signal in the Raptor. I missed that one while I was yakking. But if you're the kind of trader who can't stomach the thought of scalping in and out of a position like this, grabbing your 20 ticks, you know, your $100, and being content with that, well, then you're the kind of trader who has to have a runner in play, or perhaps initiate with a runner, or whatever. But you get my point, right? You need to understand who you are, what your risk tolerances are, what your greed tolerances are. And again, I'm not saying greed in a negative sense, rather in the sense that this is the kind of person you are and you need to trade accordingly. I suppose that's the other reason there's 1,001 trading systems. Because everybody's different, right? For me to sit here and tell you this is how you have to trade because this is what suits me, that's just silly. Because that may not suit you. All right, it looks like we're about to get tagged here on the NQ. I've also rolled in the YM stop to be a little bit cozier. We've been lucky enough to ride out the swing here in the Falcon. I don't know if we'll do that twice. But whatever the case, we've had a nice little pop-up. Yeah, the YM just tagged me, so we banked a nice little $125 profit there. Not too bad for our effort. And And I think we're going to see a little profit taking here also. Okay, so we got stopped on the hawk trade. And this is where I start to make notes in my journal. Would I have been better off staying with my ATR strategy? Would that have held me in a little bit longer? You can see that was a very nice move off of that macro pullback. We played that one pretty much as well as it could be played. And sounds like we just got stopped on our Falcon trade also, as I'm sure we're not the only ones locking in some profit at the moment. It's funny though, for the most part, the day has been kind of neutral. Like if you look at it from an overall bias, because, well, I suppose we've traded a little bit higher than the open, but we recovered all the early losses or early sell-off. Well, I won't do it here on the hawk. I'll scroll back forever. But we opened right around here at around 42.60. The market took a big dip lower. Where did it get? It got, well, I guess down here, 42.38. And we've since recovered that whole move higher. I was eyeing this red bar sell down here. Wouldn't that have been a fun one to get in on? Notice why this, red bar buy. I called it a red bar sell. Do you know why this red bar buy was a good red bar buy? No cheating. Okay, class, this is important. Why was this a favorable red bar buy? Why was Eric saying to himself, hey, Eric, you better get in on that red bar buy? I was showing you something else at the time. But why is this a good red bar buy? And I'll wait a minute for you hunt and peck typists. Oh, is nobody going to play? Not even going to make a guess? Very good. Michka gets a gold star. Test of the extreme. Right? We've had a nice move lower, move higher. Now they should recover the trend, right? They should be moving the market lower through the lows. But what happens instead? Oh, they turn on their heels and they're giving us a red bar buy signal. That would in turn become a test of the extreme to the downside, and we could expect a move higher, which of course is exactly what happened. Now, you didn't have to get in right there, although that would have been outstanding. You can always use these just as an early warning that the market might be changing direction. So you had other opportunities. There was a first micro-macro cross here. There was a macro pullback here. So it's unlikely you would have been shut out of the trade. In fact, there was a 4-arrow consolidation also. But yeah, that's exactly what it was. It was a test of the extreme. Boy, it seems like we've done a lot this morning, and it's only 8 o'clock. Al is asking or saying basically a higher swing low. Yes, absolutely, Al. That's exactly what the test of the extreme is. So it's showing us that now the buyers have control because we have a higher swing low. And in fact, it could go one further. You could say, hey, we've had a higher swing high also. This will happen 99% of the time. Folks, if you learn nothing else about trading, learn to spot these tests of the extreme. And you can do this on your own. Go to any chart and look, and you will see it time and again. And what happens as a result? Okay, well, this one actually was premature. It turns out in hindsight that this was the test of the extreme up here before prices finally went down. But look, you had multiple warnings. Right? You had several warnings. That's why a lot of times I get a little bit cautious if, you know, I'm printing a buy signal. We've got a big run up. I'm printing a buy signal. I'm a little hesitant to buy because, well, in hindsight, it might prove that this was the test of the extreme down here. I'm still thinking, gee, if I buy up here, what if the market tries to test these lows and it does a deep pullback? That's why I'm going to set up, okay, I might buy it there, but I'm going to risk it way down here. Or maybe I'll buy it above the high to make sure there's some momentum. You know, to make sure that, say, that's the test of the extreme, and now we're going to go higher. Or maybe I'll dial down my risk amount. Or maybe I'll let it engage the signal. Okay, well, we're going to pretend here. We're going to let it engage the signal, show me the limit that it's going to go, and then I'll place my order above there so I know where the current limit of the buyers and sellers are. So these are all things that you can do to protect yourself to try to stay on the right side of the trade. A very simple concept, but so important. And it's a proven moneymaker too. Like it's the principle. Once you learn to recognize it, you can be a little bit more aggressive, like Mike Filigera, and say, well, here's our eagle, here's our test of the extreme. I'm generating a buy signal. My band is just flipping over. Yeah, okay, I'll hop on that. I'll give it a whirl. Right? That's how you trade. Or here to the downside. I guarantee you Mike Filigera was all over this one. I didn't do it because the band was opposite, and I try very hard not to confuse you in the room. But you could make a case that this was a rule of 3 formation, even though it only broke twice. The principle is the same. Test of the extreme. You always need a test of the extreme before you trade a rule of 3, or any counter-trend signal for that matter. So test of the extreme, we generate a sell signal, but our band is bullish. Yeah, but we've had the test of the extreme, right? We've had the move higher and the failure. So what's likely to happen? Well, if they're not trading higher, there's a pretty good chance they're going to try to trade lower. So when the eagle fired the sell signal and it's in sync with the ATR, even though the band was contra, I guarantee you Mike Filigera was saying, yeah, I'll take some of that action. And you can see he took a little bit of heat, and we did get some subsequent sell signals. I was still a little bit bullish at this time. This was around the open. And of course, I regret not taking this sell signal with the trend because it had a very nice progression lower. But there you go. Right? So we had the early tip-off. The market was saying, I don't think I'm strong enough to go any higher. I think the sellers might be a little bit too much for me. And then down they go. Boy, is it just me or has things gotten really quiet? Great question here from Tom. Tom asks, is there any difference between a deep test versus a shallow test? The deep test seems to be, well, it's easier to take. Fib traders go nuts because they think that, you know, if they can get a 62% retracement, then it's more reliable than a 50% retracement or a 38% retracement. They're overanalyzing. For me, fib trading works in hindsight. It doesn't work so well real time. Normally, anything around halfway usually gives me a lot of confidence, but the deeper the retracement and then the failure, that shows you the strength of the buyers. We're going to talk about buyers here because we're in a downtrending market. Right? So if the market trades down this deep and then starts to go higher, that shows that the buyers are really serious about holding 42.38, doesn't it? What is likely to happen after this, however, is that the sellers will push one more time and then the buyers will jump in a little bit earlier to show their true intention. So if I got a red bar buy way down here, I would probably still take it because, of course, I can cover it just below the lows here, which makes it very easy to cover this position. Or actually, I should put those dots here. It makes it very easy to cover the position. However, I have a pretty good idea that the sellers will step up one more time before the buyers try to take it away, if in fact the buyers are strong enough to take it away. The shallow retracement, unfortunately, is a little trickier to trade, and it's one of these things that shows up in hindsight. Like, let's say the market is doing this. At this stage, I would not consider this to be the test of the extreme. Remember what the test of the extreme shows you. It shows you a significant effort on the part of the sellers to regain the trend, but then the buyers reverse them. Right? There's no question this market is in a downtrend. There is a lot of selling going on here. Sellers are dead serious about pushing this market lower. It came out of the open like a flash and just boom, 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 lower, lower, lower. A little bit of a rally. What happens? No way. Boom, 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 lower, lower, lower. So the sellers are dead serious about keeping this market down. Does this look like a serious effort on the part of the sellers? No, definitely not. Now, there are instances where the buyers are extremely strong, where in hindsight, that turns out to be your test of the extreme and the market bolts. But given what preceded this right here, given what preceded this, I would not call that a test of the extreme. I would not say the sellers have made a serious effort to regain the trend at that point. Now compare that with what happens a little bit later, and notice even the buyers put in a bigger push. The buyers said, yeah, we're pushing. So what happens? Sellers push back harder. Right? This is a little bit more serious where we are right now. That is a more serious push in response to what the buyers have mustered. So to answer your question, Tom, I like to see a serious retracement. So not to put too fine a point on it, but you know, if it's halfways or better, that usually shows a serious effort. And if it goes really deep, Like I said, if the sellers were able to push it really deep and then the buyers push them back, don't think that the sellers are done yet. The sellers are going to try to push one more time, right? Why? Because the sellers were able to take them deep. If the sellers were not able to take them deep, like they did in this instance here, they pushed back, but the buyers pushed back early. They pushed back hard. It is ever so slightly subjective, but not totally subjective. So now we have the same thing going on in reverse. Obvious uptrend, right? Some profit taking, maybe some light selling. I don't know if the sellers are really serious at this point or if this is more a profit taking move. After all, it is Friday. We're getting close. Another 25 minutes, 25 minutes, we're going to be into the lunch hour. A lot of traders might be saying, yeah, you know, I'm done for the day. This is a decent day. I'm going to take my profit, get my shovel the snow off my car, and drive home. So given the move higher here, what kind of move would we expect on the part of the buyers before the sellers were able to take the market away from them? Well, I think we would expect a pretty decent move to the upside. Right? I don't think we would expect a little hiccup like this and then watch the market fold over. And if this did happen, if we had just a little blip to the upside and the market folded over and traded down here, I think you could expect the buyers to push back harder, give us a more serious retracement, and then, and only then, if the sellers were able to recover it, there might be something sellable there. However, it's more likely the sellers would push like this, then the buyers would try, and somewhere it would fold over again. And once more, you have your test of the extreme. Right? So even though it may not unfold immediately here, somewhere through here, you're going to see this type of pattern develop, and that will be your tip-off that this market is no longer bullish. If I generate a sell signal, it may actually work out that you get a first micro-macro cross somewhere around here. And if it did trade lower and break the support through here, chances are very good the market would come back and give you a macro pullback signal somewhere around there. So even though you may not catch it initially, you're going to get another chance at that. That's why these signals are so powerful, why these macro pullbacks work, why these first micro-macro cross signals work, because they're based on price action. They're based on what the market tends to do time and again. Yeah, L says he likes to see a sharper move when testing the extreme. It does make it a little easier to trade if the market gives us a decent reaction here, right? If they come up here, fail, head lower, that makes for a much easier sell than if they start to waffle a little bit, right? If they come up here, give us a little hiccup, and then they're not sure, they trade a little lower, and then go a little higher, and back and forth. That, I agree with you. That makes for a little bit more difficult trading. But yeah, just keep your eyes open for this. And of course, to the downside, it would be the opposite. And it's worth your while, it really is, to go through your charts and just spot a few of these. It will give you a whole lot more confidence when this happens. And journal it. Journal it in your trading journal when you see it. There will be instances where you're going to get fooled, where you're going to get in too early and the market hasn't quite finished doing what it's doing. It happens. But for the most part, if you find that test at the extreme and the subsequent failure, you can usually count on a move, or a rather predictable move, the other way. And you know what, guys? Trading has dried up. There is nothing going on here right now. I don't know if they're going to wait for the lunch hour break or what they're going to do. But I think we're going to close up the room a couple minutes early. Just a reminder, no trading room on Monday. I'm out of town for a few days. I will see you guys again on Tuesday. So don't show up Monday. I won't be here.